Good evening, friends. Welcome to our YouTube channel, Evergreen Stock Market. Friends, if you are newcomer to our channel, please see our previous videos at least once. If you feel those are useful and add on to your knowledge, please subscribe to our channel. If you want to see this video in Telugu, we added that link in pinned comment. Please see that. Friends, we discussed about gold, real estate and safe investments in our previous videos. If you click on the I button on the right hand side top corner of this video, you can find all these videos there. You can see those. In this video, we are going to talk about bonds. First, let's see what are bonds. Did you ever borrow the money? Yes, most of us would have borrowed money at some stage in our lives, right? Similarly, if government or companies or banks need money for development or other business activities, they will borrow money from common public or institutions in the form of bonds. In simple terms, bonds are nothing but the loans. The entity who is taking this loan by giving the bond is an issuer, and the person who is investing in bonds by lending the loan is an investor. No one would lend the money for free, right? The bond issuer will pay interest for these bonds. The interest rate is called coupon rate. Borrowed amount is called face value. And the date the borrowed amount has to be repaid is called maturity date. Consider this example. Assume HDFC is taking loan from common public or institutions. So here the issuer is HDFC. The guy who is investing or giving loan to HDFC is an investor. And the investment amount is 1000 rupees, which is called face value. And the investment period is 5 years, which is called maturity. And the interest rate is 8%, which is called coupon rate. Next, we are going to talk about debentures. Debentures and bonds both are equal, but bonds are secured. Debentures contain both secured and unsecured bonds. Secured bonds are like home loans. For home loans, we need to show our home as a collateral for getting the home loans, right? Same like that, for secured bonds, they will show some assets as a collateral for us. So, in case of default situations, they will use that assets to repay our investment amount and interest. For these secured bonds, the risk is low. Same like as risk is low, interest rates are also low. Unsecured bonds are like personal loans. If you have a job, bank will think you can pay the loan with your salary. So they will offer personal loans, but there is no collateral here. In case if you lost the job, there is no source for them to get the loan amount. Same like that for unsecured bonds, there is no guarantee and they won't put any asset as a collateral. So the risk is high. If the company is a default risk, we don't have anything to get our amount back. Since the risk is high, interest rates are also high. Same like for home loans, the interest rates will be in between 8 to 9%. But for personal loans, it will be in between 10 to 15%. Similarly, for secured bonds, the interest rates will be in between 7 to 9. The unsecured bonds will have interest rates in between 10 to 12. Next, we'll see the difference between shares and bonds. If you are buying the shares in the company, that means you'll have ownership on the company. But if you are buying the bonds or debentures of the company, you're just lending some loan to the company. You won't have any ownership on the company. Shareholders will have right to vote, but bond investors won't have any rights. But if the company defaults, they will sell the assets of the company and they will pay the amount to bond investors first. Then only they will go to shareholders. That means bond investments are less risky than shares. Next, we'll discuss about different types of bonds. These are the different bonds which I feel important to discuss. First one is cumulative. It is same like bank fixed deposits. If the initial amount is 1 lakh and the period is 5 years with an interest rate of 8%, after 5 years, the total amount with the compound interest is 1,48,985. That means you will be taking this total amount along with principal amount at the end of the tenure of 5 years. But for non-cumulative bonds, you will be taking the interest at regular intervals like yearly, half yearly, quarterly, and monthly. Assume your investment is 1 lakh. Assume your investment amount is 1 lakh with 5 years tenure and 8% interest. If you are taking this interest yearly, you will get 8,000 rupees per year. If you are taking this for 6 months, you will get 4,000. For 3 months, it is 2,000, and monthly it is 667 rupees. At the end of 10, at the end of investment period, that is 5 years, you will get the initial investment 1 lakh rupees. Next one is redeemable bonds. That means it has maturity period. Maturity period like 5 years, 3 years, 10 years, 2 years, like that. But for irredeemable or perpetual bonds, there is no maturity period. That means you will get interest rate till the company exists or till company will get default. Next variety of bond is fixed rate. That means from starting of investment till maturity, you will get the same interest rate. If the starting interest rate is 8%, you will get the same 8% till the end of maturity. But for floating rate, they will take some reference as standard banks like SBI, RBI, or economic factors they will take into consideration. But for floating rate, they will take different standards like SBI or RBI or any other bank or economic state in the country. So according to that, the interest rates will change multiple times till maturity. For the first year, the bond is issued at 8%. It may increase to 9% in the next year or decrease to 7% in the later year. If you take the inflation rate bonds, the interest rate of the bond will change according to the inflation rate in the country. Next variety of bonds are registered and bearer. Registered means whoever name is in register, they will get the interest and final amount. When you are buying the bond, the company will register that bond on your name. So in company database, the bond will be on your name. Even if you are selling that bond to another person, but didn't change that name in the register, you will get the interest and the final amount. So whenever the registered bonds has been sold to another person, the name of the bond also has to change. Coming to the bearer bonds, it's like a currency. If you have the amount, it's yours. If others have it, it's theirs. So if you are selling the bonds, the person who brought the bonds will get the interest and he will get the final amount. Next one is call and put bonds. Call means company will buy back the bonds before maturity. Consider this example. Your investment amount is 1 lakh, maturity is 10 years with interest rate of 8%. If company wants to buy this bond before maturity, they can buy the bond after 5 years. Initially, while issuing the bond itself, they will put this clause. If they want to buy, they will buy it after 5 years. Why the company want to buy the bond before maturity? Assume they got loans with 7% or 6% rate, then why they have to pay 8% to you? In that cases, they will buy your bonds back, and they will issue some other bonds with less interest. The put is exactly opposite to call. The investors will sell the bonds to company before maturity. Why the investors want to sell it? Consider they got some other nice investment or attractive investment with higher interest rates of 10%. They can sell this to company and they can buy that particular bond, right? The last type of bond which I want to discuss in this video is zero coupon. In this bond, there is no interest rate at all. While issuing the bond, the company will specify if you invest 50,000, at the end of 5 years, you'll get 75,000 as face value. That's it. So there is no interest rate, there is no change of interest, anything. Initial investment was also fixed. Final amount face value is also fixed amount. Next, we'll see the interest rates of these bonds. The government will issue various types of bonds. Among those bonds, maximum interest rate which you will get from the government bonds is 7.75%. When it comes to corporate bonds, for secured bonds, you will get in between 7 to 9%. But for unsecured bonds, since these are high risk, you will get a high interest rate in between 8 to 10%. If you take the tax saving bonds like REC or state bonds or some other government bonds, you will get the interest rate in between 5 to 7%. Now let's see the ratings. Till now we discussed various types of bonds. In this pic, you can see the ratings of the bonds and their safety levels. If it is a AAA rated bond, it has highest safety. That means very less risk, almost zero. If it is a AA rated bond, it is high safety, which is less than AAA. And if it is A rated, it is safe, but less safe than AAA and AA. If it is rated below A, like B, B minus, D, like that, those are high risk and there is a chance of default. Now let's see how to buy these bonds. Banks like SBI, ICICI, IDBI and Axis, those kind of banks will sell these bonds. Not only their banks bonds, they will sell government bonds as well. If you directly want to buy those bonds, you can install NSE Go app from Play Store and you can directly purchase these bonds, or you can buy the bonds from company websites as well. There are some people who will buy the bonds initially from these sources, and if they will sell it in stock market as well. You can buy the bonds from stock market also. If you don't want to consider all these things, you don't want to research all these things, you can simply invest in mutual funds who will invest in bonds. Kotak, ICI, Axis, DSP are some of the mutual funds which are investing in bonds. You can consider these options. That's it for today, guys. Thank you for watching our video. If you like this video, please like, share, comment and subscribe to our channel for more interesting videos. See you guys in the next video. Until then, stay home, stay safe.